The first thing I'm going to do is I'm going to just go to VisionWorks and instead of putting all of this on the tactics page, solutions tactics, we started off by creating the planning tactics feature in its own separate window. And I'm still a little undecided whether we'll keep it all here or move it back to planning tactics. So far, I actually think it works quite well here. So I'm going to run through just the overall layout with you, and then we'll actually use some tactics, apply them, and I'll explain a few of them to you. You'll see how everything works, and then we'll go forward and we'll actually look at building a report. So first of all, in the upper left corner, I want you to notice that you can create unlimited solutions just as you normally would. And I'm going to do that right now because the planning tactics solution doesn't have any tactics applied, so we can think of it as kind of our base case. So I'm going to copy this and just create a new solution, and I'm just going to call it planning tactics applied. And then when we do reports, we're going to be able to compare the two solutions to see the difference that they make. You can also see that you can change life expectancies. And when you do, or if you do, any of the applied tactics will automatically update based on the life expectancy. I think one of the most powerful features that we have is this wealth optimization estate preservation slider. And the way it works is what's more important to the client? Is it wealth optimization? Or for clients that are reasonably wealthy, our high net worth clients, it may very well be estate preservation, or there's a choice of a 50-50. And some of these tactics will be the same, whether you select wealth or estate, but a number of them will definitely change if you select estate over wealth. The lower left, we see the whole tactics area. So there are 15 tactics right now. We will add more as time goes on, but these are some of the key ones. And then you have this upper right area. And the way the software works is if you select a tactic, then the entries relevant to it are presented in the upper right. So we can see excess cash. I'll come back to that. But if I select Optimize OAS CPP, you can see start dates for OAS CPP for both Bill and Sue. You can, and you can see here, the non-reg portfolio is 100%. That's the default for any excess cash. But you can see here, I could go in, select TFSAs or RSPs, put in percents and so on, kind of manually enter things, and then click the tactic effect. This is no different from what you do now on the Tactics tab, but you can also simply click Optimize and let the software figure everything out for you. So that's the key thing. So we've given you the opportunity to manually play with things if you want to, or select Optimize. Down here, we have all of the results fields, and the change in results shows taxes saved, any impact on OAS clawback, the net impact, the sum of the two, and then the total plan difference, which can be different from the total net impact, simply because if we're saving taxes, for example, or paying less in OAS, then we're retaining wealth, and that wealth can be growing in TFSAs or RSPs or whatever. So there's that whole secondary effect of, returns on additional capital available to us. On the right, you can see we have the estate value projection, and you can see that also down here in the lower right. So we've got the value of the estate, which of course is income producing assets plus things like homes, and then also the residue for distribution. So keeping in mind that becomes important. If we're focused on estate, we want a positive residue for distribution, or at least neutral. But if we're focused on wealth, we may allow the residue for distribution to be negative. Our attitude is we want to maximize our wealth to enjoy it in our lifetimes. And as far as we're concerned with the estate, If our house needs to be sold to raise the money to pay terminal expenses, so be it. That's up to our heirs to manage all of that. I also want to just comment a bit on the graphical output. So we have the income assets, and as you all know, they're the assets that we'll use to buy groceries in retirement. So non-reg portfolios, TFSAs, RSPs, rental properties, cash value of life insurance policies, and so on. And in our particular case, the green line, the main bank account, is zero. So we've got plenty of cash flow to manage our expenses in life. What we're trying to do now is optimize things. And you can see our starting portfolio combined for the couple is about 1.7 million, which I don't think is, outrageous in today's world, given the advances in the stock market in the last 15 years. We also have two other graphs, which are really quite interesting: taxable income for Bill and taxable income for Sue. And we'll be looking at these a little bit later. So you can see the scale across the bottom. The white area is the first tax bracket, the light gray is the second, the darker gray is the third, the black line is OAS clawback. And I want to remind you, this is taxable income. So to the degree we're taking income from TFSAs, that helps meet our expenses, but it's not taxable. Same thing, we may take capital out of our non-registered portfolios, so we have that capital withdrawal triggering some taxable income, mainly capital gains. So you can see for Bill that his taxable income is into the third bracket and pushing for a lot of his years up into the second bracket, and in a couple of cases, well up into the third. And then if we look at Sue, she's under the first bracket for a period of time, and then up into the second bracket, and then in some points way into the third. So we'll come back and have a look at how applying these tactics makes changes. So the first thing I'm going to do is just excess cash. Now, there are a couple of tactics where you do need to make some decisions, and this is one of them. So I'll select optimize, and then I'll talk about any excess cash going to pay down the line of credit, go to Bill's TFSA if he has unused room, RSP, non-reg portfolio, same thing for Sue. And you'll notice in this case, ABC Advisors. So that's a competitor of ours. So we don't want to select our competitor's portfolio for excess cash. And then also you could have, for example, retirement plans, RSPs at work, and we don't want to select those because they're already being contributed to what the maximum that's allowable. So a couple of selections, fairly straightforward, fairly obvious. And then when we click continue, the software will go through and figure out for us what's the optimum for us to do as far as where any excess cash should go. So we'll just let that process. And this is going through a huge number of combinations. And that's the whole point. The software can do that very quickly, far faster than we can, manually sort through the different combinations. So it's telling us pay off the line of credit. If there's any money left over, contribute to a TFSA. If there's any money left over after that, contribute to an RSP. And then finally, any joint portfolio. So I'm just going to click OK. And what we see is the tactic effect. Now, there are two arrows. If I click this arrow, it's showing the plan difference, also the estate and residue for distribution difference for this particular tactic. And it also shows it here. And the total plan difference, you'll see in a minute, is going to change as we apply more tactics. In other words, this arrow is specific to the tactic. This arrow is a cumulative result for all applied tactics. So all we need to do is click the apply button. And we can see a bit of a change on the graph. It's nothing too much, but we're working in the right direction. Portfolio start ages, these are already actually the optimum, just the way, things worked out. But I'm going to click calculate anyway. And the reason that I like to test the different options is simply because you can see the gray circle, meaning no change. The reason I like to do it and click apply is because now I have the checkbox selected over here on the left as an applied tactic, gray circle, no change. But it just reminds me that I've tried that tactic and, I know I haven't skipped anything. The next thing I'm going to do is, of course, look at optimizing OAS and CPP. And I might mention, you can see the defaults are age 65, kind of the norm. The one thing I would like to mention is I encourage you to use the tactics in the order presented. Now, we did an extensive amount of testing, something like 3 weeks. And what we found was in about 20% of the cases, changing the order made a difference, but the maximum difference was only 2.5%. And very often the difference was less than 1%. So trying a certain order of the tactics, then trying a different order, and so on, would actually take quite a lot of time for really no particular result. So we've organized these in an order that I think is most effective, but changing the order is not a significant difference. So you've got a couple of choices. When would you need to start OAS just to pay your bills? And for some people, it could be earlier, it could be 60. Or there's the selection for maximizing plan results. And in this case, we can see, push it out as far as possible to age 70. So since we're interested in wealth accumulation, I'm going to select age 70 and apply that. And then what you're going to see is that the effect of that result is actually almost $250,000. And the cumulative effect of the two results is over $250,000. And I find this very interesting because, and you can see, of course, we're going to pay more in taxes. We will save some OAS clawback. And so the tax, that impact is 20,000. So this total plan difference is after taking into effect those higher taxes. So the question is, how come the difference is so striking, almost $250,000? And it's not just because we're going to get more OAS and CPP, from 70 on. It's also because when we get more OAS and CPP, we're going to end up withdrawing less from our TFSA and RIF, and that money is therefore going to sit in them and compound tax-free. And there's nothing really more powerful than, compounding returns. So the whole idea of the optimizations and letting the software figure everything out is that it will consider things that we might not have thought about. So everything is included when it's figuring out the preference. The other thing I want to show you, because I find this really interesting as well, is that any of the graphs with hash lines is the pre-change amount and the solid area is the post-change. Now, in this case, the solid area is actually hiding, if you will, behind the pre-change amount, and that's why there are some hash lines over it. But here we can see the pre-change amount is actually higher. So this is answering one of those key questions, when should I take OAS and CPP? And what it's basically saying is, if you take OAS and CPP, if you defer to age 70 and you're comfortable with a life expectancy of 80 and 75, which is essentially the crossover point, then it's better to defer. And once you hit 80 to 75, you can see the positive advantage, the solid area. If you're not comfortable with that life expectancy, then up to that point, then you may want to reconsider and start OAS and CPP earlier. So that graph is, I think, very informative. Next thing I'm going to do is optimize the portfolio withdrawals order. Oh, I wanted to mention, by the way, when we applied that second tactic, what the software did was it also informed us about the effect on the first tactic that we applied. So they're not just taken in isolation. All of the tactics interact with each other, and the output is actually telling us what that interaction result is. So in this case, the planned difference, which was optimizing excess cash for a $44,000 advantage, it's actually now increased to a $75,000 advantage. So let's go on and do portfolio order optimization. All we need to do again is click optimize. We've got everything selected except the line of credit. We don't need to dip into it to finance our retirement. So we'll just click continue. And again, the software is going to go through and it's going to test all kinds of different combinations, non-reg, TFSA, RSP, RSP, TFSA, non-reg, go through the whole run. And we can see non-reg, TFSA, RSP. That's fairly logical because it's saying draw down our non-reg money first, keeping our funds in registered accounts, again, where they can compound tax-free. And we can see that that tactic makes a difference of 309,000, and the cumulative difference is now 576,000. We can also see, by the way, if we have once we apply, if we have a look, what's the effect on some of the other tactics? Well, the planned difference for excess cash has gone from 75 back down to 23. So despite all of these individual changes, the cumulative effect is still 576. And then I'm going to select transfer splitting. And what that's going to do is transfer any donation or medical credits, back and forth for a couple, one-time election to share CPP, should we do it or not, and then annually, splitting pension income. So again, all we need to do is click optimize and let the software figure all of this out. And we can see that sharing CPP and splitting pension income is the optimum. So we'll apply that. And now what you'll see is that the combination of these really 4 tactics, you can see portfolio withdrawals orders actually changed a little bit, but it's now $607,000. And I want to show you now these taxable income graphs. This is what becomes really interesting. So if we click on Bill's taxable income, you can see that his taxable income was actually up into the 3rd bracket, and now it's being pulled down into the 2nd bracket, fairly close to the OAS clawback level. And you can see here from the 2nd bracket down to the 1st bracket, and in that, and then just slightly into the 2nd bracket for a certain period of time. And then in combination with Sue, you can see that in her case, a lot of income late in life after Bill's death is now spread into her later years, but that brings things down under the OAS clawback level, so she retains her OAS. So I think these 2 graphs are actually, very informative. I'm going to save portfolio allocations, and we'll come back to this because it's a bit of a different topic. But I will go to RSP RIF meltdown, and this is a very common consideration for people. Shouldn't I melt down my RIF? I'm going to take income now at a lower tax bracket than taking income later in life when I'll have a higher RIF income, pushing up the taxes on it and so on. And I would say that in almost every case that I've ever tested, it's not a good idea. And that may fly in the face of logic, but the reason is very simple. and it's because of the power of compounding. So if I melt, yes, I'll pay less in taxes, but if I pay less in taxes, I forego retaining the money in my RIF where it's compounding tax-free, meaning the effect of compounding is more powerful than any small tax advantage I might gain by taking RIF income early. So we'll just let that process. Obviously, that's a fairly detailed calculation. I might just, while it's processing, I might just mention that you can also do RIF over withdrawals, which says I won't contribute to my TFSA from cash flow. I'll take money out of my RSP, use it to contribute to my TFSA, so the money remains tax sheltered. I'll pay a little bit of tax on that extra tax on that RIF income. But then I'm also moving money into a vehicle where I'm not going to pay any terminal taxes. So you can see that the RIF meltdown is off for both Bill and Sue. It's not a viable technique. If you do apply the RIF meltdown, then the RIF over withdrawals, they're mutually exclusive. You can do one or the other, but not both. Loop back to the beginning. What we've attempted to do is, and I think, once you play with this, you'll see, is to give you the time, or I don't want to say give you the time, enable you to spend more time sitting down with people and actually having a conversation about the life they want to live. And again, this whole visual approach stimulates their thinking, and they get involved. Some of my favorite examples are things like, okay, fine, we're going to educate kids, but we also can talk about launching them. And when we talk about things like weddings, people think, we all think in terms of mental images, so we actually picture a child's wedding. And the area of the brain that's responsible for constructing those images is linked to the area of the brain responsible for our emotions. So when we think about a wedding, we picture it, we feel an emotion. Or, helping with the down payment on a house, how would that feel? And, all those sorts of things. So to spend the time and really help people evolve that vision, and then we can apply the planning tactics to figure out the optimum thing to do, at least from a financial point of view, very quickly, and then produce a report that I think is fairly attractive and fairly informative and fairly straightforward, that shows exactly the impact of, applying those tactics. Very simple to produce the report. So we're not going to spend any time anymore constructing the plans. We're going to spend time with the client, and in doing so, deepen relationships and give them a value add that I don't think anybody else is providing. Most advisors sit down, have a conversation. What do how much income do you want in retirement? And what are some of your retirement goals? Oh, I want to take a trip to Greece. I've seen that a few times. And then, here's your plan. Instead of, really talking with them about life and what's important to them. So that's the whole objective, is to optimize all the plan production. So thank you for your time. My apologies for a few forgetful moments on my part, and hope you have a great weekend.
Okay, thanks, Michael. It's good. It's great.
Okay, my pleasure. Thanks, Greg. Bye.
Bye-bye now.